Hello and welcome back to Financial Freedom Hub. In this video, we are going to talk about one of the most overlooked items on the balance sheet, treasury stock. We encourage you to watch the video till the end, because in the end we will articulate a secret rule that the world's greatest investors use when evaluating companies to avoid making risky investment decisions. You might also want to check out our playlists, How to Read Any Company's Income Statement, Balance Sheet, and Cash Flow Statement. In our videos, we reveal all secrets of financial statements and teach you to understand the financial statements, row by row. If you subscribe to our channel and turn on notifications, you will never miss our new videos. So, without further ado, let's get started. Treasury stock is the amount that a company has used to buy back its own shares of stock from the public. These stocks have no voting rights, and they don't receive dividends. Why would a company want to repurchase its shares? Well, there are several reasons, such as to increase the earnings per share, EPS, by reducing the number of outstanding shares, to boost the stock price by creating more demand and less supply, to use the shares for employee compensation or stock options, to prevent a hostile takeover by acquiring a large stake in the company, to signal confidence in the company's future prospects and value. If a company management decides to buy back its shares, they think that the shares are worth more than the current market price. The company can then retire the shares permanently, or keep them indefinitely, for reissuing later. They cease to exist when they are cancelled. But when they are kept, with the possibility of being reissued later, they appear on the balance sheet's shareholders' equity section, with a negative value. On the balance sheet, they reduce shareholders' equity, and increase the return on shareholders' equity ratio, ROE. ROE is a measure of how well a company uses its equity to generate profits. This is why a high ROE is usually a sign of a good investment. But to make the best investment decisions, we need to be smarter than that. While a high ROE is one of the signs that indicate a good company, it's worth to know how it's created. High ROE can be created either from financial engineering or good business economics, or the combination of both. Repurchasing shares can also be used to manipulate ROE, using financial engineering. This artificially inflates the ROE by reducing the denominator, equity, without affecting the numerator, net income. Now, how can we tell if a company's ROE is genuine or not? How can we distinguish between a good business, with a competitive advantage, and a mediocre one, with financial tricks? Well, we will adjust the ROE formula. We will take the value of treasury stock, replace its negative value with positive, and add it back to shareholders' equity. This will give us the ROE without the financial engineering effects. Let's see an example. Suppose we have two companies, A and B, with the following data. As you can see, both companies have the same net income and ROE, but different shareholders' equity and treasury stock. Company A has bought back 100 worth of shares, while Company B has not. Which one is a better investment? If we use the conventional ROE formula, we might think that they are equally good. But if we use the adjusted ROE formula, we will get a different picture. The adjusted ROE formula is net income divided to shareholders' equity plus treasury stock. As you can see, Company B has a higher adjusted ROE than Company A, meaning that it is more efficient and profitable with its equity. Company A's ROE is inflated by its treasury stock, which does not contribute to its earnings. So, the secret rule for you to follow, that has made the world's richest investors millions and billions, is this. Companies with treasury stock on their balance sheet, with a consistent history of buying back shares of their own stock, yet having a high adjusted ROA, are highly likely to have good business and a competitive advantage, to make their owners super rich. We hope you learned something new and useful from this video. If you did, please hit the like button, and subscribe to our channel for more videos on investing and financial freedom. Thank you for watching and see you in the next one.